As Russia scours the globe for buyers of its energy products, it is finding eager trade partners in an unlikely place, the oil-rich petrostates of the Persian Gulf. Since Western sanctions over the war in Ukraine cut off Russia from many of its established trading partners, state companies from Saudi Arabia and the United Arab Emirates have stepped in to take advantage of discounted prices for Russian products, according to oil executives and industry analysts. Despite U.S. objections, the Gulf countries are using the discounted Russian products internally, including for consumption and refining purposes, and exporting their own barrels at market rates, boosting their profits. The Gulf countries, especially the UAE, have also become key storage and trading hubs for Russian energy products that can't be as easily shipped around the globe because of the war. The UAE has become a major storage and re-export hub for Russian oil products, while some traders are making a brisk business shipping Moscow's cargoes to other destinations using the Gulf nation and its financial system as a base. Private trading firms import from Russia to the UAE, mostly for re-export purposes to Pakistan and Sri Lanka or East Africa, said Mr. Aliyev. Some of Russia's discounted oil cargoes are scooped up by Emirati state-run companies, including 5 shipments of gasoline to the Dubai-based Emirates National Oil Company since December. In November, a cargo of 700,000 barrels of Arctic crude oil loaded by Russian government giant Gazprom PJSC was delivered to a refinery of the Abu Dhabi National Oil Company, which is owned by the Emirate Kepler data shows. Some transactions appear to be designed to be discreet, avoiding the scrutiny of banks and insurers involved in the trade, and also because dealing with Russia is politically sensitive. Aramco has often been buying oil cargoes that were initially sold by Rosneft Oil Company, a Russian oil company whose trading arm is sanctioned by the U.S. But the shipments were carried through transshipments in the Mediterranean, sometimes using Emirati intermediaries and then stored in the UAE rather than delivered directly to Saudi Arabia. The trade shift in Russian oil flows is benefiting Moscow's Middle Eastern allies in the OPEC Plus pact, as the biggest Arab Gulf oil producers, Saudi Arabia and the United Arab Emirates, UAE, scoop up Russia's fuels at discounted prices. With Western markets essentially shut for Russia's crude and products, new trade routes have emerged, and the countries sitting on some of the largest oil reserves are now importing Russian diesel, naphtha, and fuel oil, according to tanker tracking and data commodity services. Since the Western countries announced they would impose embargoes and price caps on Russia's crude oil and oil products, the reshuffle of oil trade out of Russia has involved the Middle East as a major importing and trading hub. In 2022, Russia's oil exports to the UAE hit a record 60 million barrels, triple compared to the previous year. Fujairah, the biggest trading hub in the UAE, is now receiving a lot of Russian oil products, whose volumes are now second only to gas oil from Saudi Arabia, per estimates from Argus Media. Earlier this year, Russia started exporting fuels to Saudi Arabia, the world's top crude oil exporter and de facto leader of OPEC. Saudi Arabia and Russia are also the leaders of the OPEC and non-OPEC producers in the OPEC Plus alliance, which has been coordinating crude oil supply to the market for more than 6 years now. Kepler estimates that Russia is now sending around 100,000 barrels per day, BPD, of fuels to Saudi Arabia, compared to virtually zero before the Russian invasion of Ukraine, per data quoted by the journal. Russia seems to be accelerating its exports of diesel to Saudi Arabia through both direct shipments and ship-to-ship transfers. Russia started exporting diesel to Saudi Arabia in February after Moscow's key fuel export outlet, the EU, enacted an embargo on seaborne imports of Russian oil products on February 5th, Reuters reported earlier this year, quoting traders and ship tracking data. Using STS loadings, Russia is shortening the routes for tankers headed to Africa and Asia, after Moscow is now banned from exporting fuels to the EU. The EU banned, effective February 5th, seaborne imports of Russian refined oil products, and around 1 million BPD of Russian diesel, naphtha, and other fuels had to find a home elsewhere if Moscow wanted to continue getting money for those products. The flow of Russian fuels to third countries is also regulated by price caps, similar to the cap on Russian crude if the trade is carried out through Western insurers. The cap on Russian diesel is $100 per barrel, while the cap on lower-cost petroleum products is set at $45 a barrel. As Russia's oil reshuffle continues, some trading patterns are solidifying. India and China have emerged as the top strategic trading partners for Russia, accounting each 1/3 of total arrivals of Russian oil in March. In considering the alternative markets for Russian oil after the EU ban, there has been an interesting distinction of crude, naphtha, and fuel oil exports being concentrated among a handful of destination countries in Asia and the Middle East, whilst diesel supplies have headed towards more diverse markets including Saudi Arabia, Turkey, Brazil, etc. Russian diesel exports jumped by 33% in March, with shipments from Russia's Black Sea ports going to the east and western Mediterranean regions to countries such as Libya, Egypt, and Tunisia. Exports out of the Baltic Sea ports have shifted fairly evenly in terms of percentage share to Brazil, Saudi Arabia, Egypt, and Morocco, Vortex's senior market analyst Pamela Munger said earlier this month. Russian exports to the Middle East are growing despite efforts from the United States to dissuade Russia's allies in OPEC, plus from supporting trade and purchases of Putin's oil. Early this year, Under-Secretary of the Treasury for Terrorism and Financial Intelligence Brian Nelson traveled to the Middle East and Turkey. In visits to Oman, Abu Dhabi, Dubai, and Turkey, Nelson discussed Treasury's efforts to crack down on Russian attempts to evade the international sanctions and export controls imposed for its brutal war against Ukraine, Iran's destabilizing activity in the region, illicit finance risks undermining economic growth, and foreign investment. Yet the rising Russian fuel exports to Saudi Arabia and the UAE show the waning influence of the United States among its key allies in the Middle East. EU is still largest importer of Russian oil due to loophole in sanctions. The European Union is the largest importer of fossil fuel energy from Russia, despite the bloc leading in the implementation of the strictest sanctions against Moscow, new data has revealed. The reason the EU is still the largest importer is continues to purchase a record number of crude products through the main buyers of Russian oil. 5 laundromat countries that export Russian crude to the EU were identified by the Center for Research on Energy and Clean Air, CREA, in its new report. The countries ramp up their imports and sell the refined products to Western counterparts that have imposed sanctions to whittle down the Kremlin's revenues that fund the Ukraine invasion. The 5 countries are China, India, Turkey, the United Arab Emirates, UAE, and Singapore. The report noted that even though the EU currently uses legal means to import Russian oil by changing import origin, it continues to fund Vladimir Putin's war chest. The EU, Group of 7, G7 countries, and Australia have joined the US in imposing some of the strictest sanctions, an embargo on most oil export to Europe, and a G7 price cap on Russian crude to crack down on Russian crude oil and oil products. Another round of sanctions in which the EU embargoed refined products like diesel, gasoline, and others had taken effect in February this year. The price cap also applied to these products, but imports of these products have increased by leaps and bounds from the laundromat countries, all of which became the largest importers of Russian crude since the invasion, the report said. The EU, G7 countries, and Australia have imported a total €42 billion worth of oil products from the laundromat countries for the entire year since the Russian invasion, it found. And the EU, which has claimed its sanctions are effective in reducing Russia's revenues from fossil fuel exports, is the largest importer. Its oil imports have amounted to €7.7 billion in the year since the invasion. Lori Miliverta, the co-author of the report and co-founder and lead analyst at CREA, said the imports blunt the effect of the sanctions on Russia. Increasing the imports of oil products from the main importers of Russian crude oil undermines the oil sanctions against Russia. On the other hand, clamping down on this trade is an opportunity to exert badly needed additional leverage and cut off financing for Russia's brutal invasion of Ukraine, he said. Of course, the situation also highlights the oil dependency and lack of action to reduce oil demand by the EU and G7, he said. The imports of Russian crude oil by the 5 Asian and Middle East countries rose to more than 140% in volume compared to the year before the war, with the total value of imports rising to €74.8 billion. The report found the oil sanctioning countries were responsible for the vast majority of the increase in the laundromat countries' oil exports during the invasion. Their exports to the West had increased by 80% in value and 26% in volume. The price cap coalition countries had increased imports of refined oil from China by 93%, from India by 2%, Turkey by 43%, UAE by 23%, and Singapore by 33%. Why do Saudi and Russia need each other? Saudi oil is cheap to extract, and the kingdom only needs prices at $50 to $55 a barrel to fund its imports and offset remittance outflows. But it requires a higher price of $75 to $80 to balance the budget, and even that doesn't tell the whole story. Saudi Arabia has an expensive social contract with its citizens, promising prosperity in return for political acquiescence. To keep its side of the deal, the government needs to invest in its non-oil industries, which employ most Saudis. Petrodollars pay that bill. Saudi Arabia's sovereign wealth fund aims to spend $40 billion a year on the domestic economy, including the construction of Neom, a futuristic city in the desert with an estimated price tag of $500 billion, on top of outside investments. Those figures don't show up in the budget. To meet all these goals, the kingdom needs an oil price closer to $100. In Russia, meanwhile, President Putin is counting on oil revenues to fuel his war machine. Bloomberg Economics. Russia economist Alex Isakov calculates that a price tag of $100 a barrel is required to balance the Kremlin's books. In response, the White House appears unfazed with the latest round of production cuts. This may partly reflect expectations that the actual output decline may be smaller than the headline number of over 1 million barrels per day. Compliance among OPEC Plus members with the cuts may also be less than perfect. In February, Russia pledged to unilaterally cut output. In reality, flows only began to fall last week. Still, the consensus among analysts is for oil prices to average between $85 to $90 a barrel this year and next. What if OPEC Plus decides to come up with another output cut next year, ahead of U.S. presidential elections, undermining Biden's chances of winning? Bloomberg's economic scenario modeling tool, Shock, suggests that supply cuts pushing oil to about $120 per barrel in 2024 would keep U.S. inflation at nearly 4% by the end of 2024, compared with a baseline forecast of 2.7%. And conventional wisdom says that high pump prices hurt incumbent politicians at the ballot box. What do you think about the United States oil sanctions on Russia? Let me know down below. If you want to continue to learn about business investing and financial education, we have got 2 more videos waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos about investing. Thank you so much for watching, and I'll see you in the next one.